Hello, good day. I hope you are fine. In this video, I'm going to introduce technical analysis to you. Technical analysis is a fascinating field of study. It is as much science as it is art. In technical analysis, the trend is your friend. The title of this video is Does Technical Analysis Work? Let's find out further. In this video, we are going to explore what is technical analysis, what are the major assumptions of technical analysis, how does technical analysis differ from fundamental analysis, what are the major advantages and disadvantages of technical analysis. More importantly, we seek to answer the question of does technical analysis work? Shall we learn technical analysis? I was a fundamental analyst by training during the early days of my career. However, with development of technology and software, I think it is necessary for analysts to have some basic knowledge of technical analysis. This video is the first in my series of videos on technical analysis. I think by creating a series of videos on technical analysis will help students to learn, appreciate, and apply technical analysis in investment valuation. Our university is rich with financial database and technical tools that will truly enhance your learning process. Stay tuned and let's learn together. What is technical analysis? Technical analysis involves the examination of past market data, such as prices and the volume of trading, which leads to an estimate of future price trends. Technical analysts attempt to analyze recurring patterns in stock prices to generate superior investment performance. Technical analysis provides a framework for informing investment management decisions by applying a supply and demand methodology to market prices. Technical analysis essentially serves two main objectives. First, for identification. Technical analysis identifies and describes past and present price action. It serves as a historical record of what has transpired in the markets. It provides a descriptive representation of market action. This allows the market practitioner to observe how the market has performed in the past. This information is especially critical prior to any investment or trading decision. Second, for forecasting. Once a particular price or market action is identified, the technical analyst may now use this information to interpret what the data actually means to infer future price action. In general, technical analysts seek to answer the following questions. First, what security should an investor buy or sell? Second, when should the investment be made? These are important questions for investment decision making that every investor would like to know. Technical analysis is based on several key assumptions. First, the market price is determined by the interaction of supply and demand. Second, supply and demand are governed by numerous rational and irrational factors. Included in these factors are those economic variables relied on by the fundamental analysts, as well as opinions, moods, and guesses. The market weighs all these factors continually and automatically. Third, disregarding minor fluctuations, the prices for individual securities and the overall value of the market tend to move in trends, which persist for appreciable lengths of time. Fourth, prevailing trends change in reaction to shifts in supply and demand relationship. These shifts, no matter why they occur, can be detected sooner or later in the action of the market itself. There are two main approaches to analyzing stocks: fundamental analysis and technical analysis. Fundamental analysis look at economic, industry, and firm factors to determine the intrinsic value of a stock. On the other hand, technical analysis looks for patterns or trends in security prices. Most technical analysts admit that a fundamental analyst with good information, good analytical ability, and a keen sense of information should achieve above average returns. However, according to technical analysts, it is important to recognize that the fundamental analysts can experience superior returns only if they obtain new information before other investors and process it correctly and quickly. Technical analysts do not believe that the vast majority of investors can consistently get new information before other investors and consistently process it correctly and quickly. Technical analysts believe that using data from the market itself is a good idea because the market is its own best predictor. Technicians do not deny the value of fundamental information, but believe that prices only gradually move to its intrinsic value. As fundamentals shift, traders can exploit the adjustment to a new equilibrium. Therefore, technical analysis is an alternative method of making the investment decision. For technical analysis to be profitable, the market has to be inefficient. Let's look into an example for further explanation. Suppose there is a trend in the market in which a stock is consistently trading low on Monday and high on Friday. In an efficient market, investors who observe this trend through technical analysis would buy the stock on Monday, pushing its price up, and sell on Friday, pushing its price down. By these trades, the trend of the stock of being low on Monday and high on Friday will be eliminated. However, when the market is inefficient, the trend would continue, and the technician can buy low on Monday and sell high on Friday to make a profit. Next, We are going to explore the implication of the empirical test of the efficient market hypothesis on technical analysis. As we have just learned, for technical trading rules to generate superior risk-adjusted returns, the market would have to be inefficient. That is, the market would have to be slow to adjust prices to the arrival of new information. This is referred to as the weak form efficient market hypothesis. The two sets of tests of the weak form efficient market hypothesis are the statistical analysis of prices to determine if prices move in trends or were a random walk, and the analysis of specific trading rules to determine if their use could beat a buy and hold policy after considering transaction costs and risks. Almost all the studies testing the weak form efficient market hypothesis using statistical analysis have found that prices do not move in trends based on statistical tests of autocorrelation and runs. These results support the efficient market hypothesis. Regarding the analysis of specific trading rules, the vast majority of the results for the trading rules tested support the efficient market hypothesis. To conclude, when the market is weak form efficient, technical analysis would not work. This means technical analysis cannot generate superior risk-adjusted returns. What are the advantages of technical analysis? First, technical analysis is applicable across all markets, instruments, and time frames, where price patterns and indicators are all treated in exactly the same manner. No new learning is required in order to trade new markets or time frames. Unlike in fundamental analysis, where the analyst must be conversant with the specifics of each stock or market. Second, there is no need to study the fundamentals of the securities traded, since technical analysts believe that all information that impacts or potentially impacts the stock is already reflected in the price on the charts. In addition, technical analysis provides a clear visual representation of the behavior of the markets, unlike in fundamental analysis, where most of the data is in numerical form. Fourth, technical analysis provides timely and precise entry and exit price levels, preceded by technical signals indicating potential bullishness or bearishness. Technical analysis has the ability to pinpoint potential time of entry via time projection techniques not available to fundamentalists. Fundamental analysis does not provide the exact price or time of entry. Lastly, technical analysis makes the gauging of market risk much easier to visualize. Volatility is more obvious on the charts than it is in numerical form. There are disadvantages in applying technical analysis. Technical analysis is subjective in its interpretation. A certain price pattern may be perceived in numerous ways. Technical analysis is susceptible to the possibility of interpretational ambiguity. A basic assumption of technical analysis is that price behavior tends to repeat. Unfortunately, this tendency to repeat may be disrupted by unexpected volatility in the markets caused by geopolitical, economic, or other factors. Popular price patterns may also be distorted by new forms of trade execution like automated, algorithm, or high-frequency program trading. Another argument against technical analysis is the idea of self-fulfilling prophecy. Proponents of the concept contend that prices react to technical signals not because the signals themselves are important or significant, but rather because of the concerted effort of market participants acting on those signals that make it work. In our syllabus, we are going to learn the following 4 common technical tools. They are shown as follows. The Thomson-Reuters data stream system that is available in our University of Reading, Malaysia, has 10 technical analysis tools. I hope you will explore the system and learn about them. If time allows, I hope to record more videos on how to use these technical analysis indicators. Does technical analysis work? Independent researchers have confirmed the value of technical analysis, beginning with the confirmation of the momentum anomaly. Momentum, or relative strength in the vernacular of technical analysis, has been applied since at least the 1930s. It is now widely accepted that relative strength analysis can help investment managers achieve statistically and economically significant assets. Additional research has confirmed the value of other technical tools, including pattern analysis, moving averages, and indicators. After considering the efficient market hypothesis, the advantages and disadvantages of technical analysis, shall we learn technical analysis? According to Brown and Raleigh, numerous investment professionals and individual investors believe in and use technical trading rules to make their investment decisions. Many investors using these techniques claim to have experienced superior rates of return on many investments. Many newsletter writers base their recommendations on technical analysis. Even the major investment firms that employ many fundamental analysts also employ technical analysts to provide investment advice. Therefore, whether you are a fan of technical analysis or an advocate of the efficient market hypothesis, you should still have an understanding of the basic philosophy and reasoning behind technical approaches. Although I am a fundamental analyst, I think it is not very difficult to take a look at the technical charts before you make a buy or sell decision. Once you are familiar with technical analysis, it is just as easy as taking a glance. It is never wrong to consider more factors. Finally, we have come to the end of this video. I hope you have learned some knowledge from this video. If you like this video, please click like, share or subscribe to my YouTube channel. Thank you. See you and goodbye.